Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
We're in a very eventful last few days in the world of AI with Stargate, with DeepSeek. Why don't we get into what you found most interesting about some of these announcements?
Yeah, absolutely. So for context, we are talking on Monday, just after 4 p.m. Eastern time, so just after the market closed on the day of the great DeepSeek bloodbath. So it's been a fun, interesting couple days. And one of the weird things about it, and this happens sometimes, is that there will be a story that is just kind of lurking and plodding along for a while, and then suddenly Wall Street wakes up to it and decides it's a huge deal. And this happened a couple of years ago. You might remember this outbreak of some weird respiratory disease in some town in China that, town of tens of millions of people that know what I've heard of. And there was a while I remember being really aware of COVID and being concerned and stocking up on bulk food and researching masks and things, and being really confused that the market was just kind of chugging along. And then there was one day, the day that the outbreak in Italy happened, where the S&P was down like 4%. And it kind of felt like, surely I'm not the only person who's been paying attention to this. And I think people have been just waiting for this to be the actual thing that's moving the market. And so my first reaction to this was, okay, 4% is roughly what people think the impact of COVID is. And then we had the fastest market downturn in history. So I got that one wrong. And last week on Friday, I was looking at some stocks in the afternoon, and I noticed that Nvidia was down like 4%. And I figured, okay, finally, people have read the DeepSeek paper. Maybe someone on the sell side has summarized it for their clients, or someone has decided that this is an interesting short thesis for Nvidia. And so I figured 4%, that's the reaction. And then today, that was not the reaction. There was a substantial decline after that. And I guess like the first thing to think about is that this just happens with a lot of stories where there's some important change in the world, and there's going to be a cohort for whom it was the thing to talk about, and then it became old news. And then there's a different cohort of people who suddenly wake up to it and get really worried. And what usually happens in that case, as happened with COVID, was once that worry is expressed in the market, there is an overreaction. And some of that overreaction is that when you're doing really fast analysis on some really, really negative story, you do tend to exaggerate downside. So some of this is people just literally putting in the wrong number for Nvidia's revenue in 2026. And then some of it is that a lot of market participants are levered, whether that's they literally have margin debt, or they have the implicit leverage of they work at some institution, they have some job where part of their job is allocate capital, and they know that if they lose a certain amount of capital, they get fired. So if you think about someone's incentives like that, like if they manage $1 billion and they know that they will lose that job if they lose 10% of their assets, then in one sense, they're already levered 10 to 1. Like they have $1 billion of which they can only lose 10%, which is exactly the position you're in if you just have a position and you've borrowed 90% of what you spent to get that position. So for those people, there's actually a really interesting, just kind of stylized fact. It's broadly true about the cadence of returns and volatility. And for a lot of professional money managers, their mandate is produce good risk-adjusted returns, and their firm is going to figure out the capital structure that actually optimizes what those returns are. And if you have a certain risk versus volatility ratio, you can have different products that are the high risk, high volatility, but also higher return version. And the converse of that, it's not really your job to figure out exactly those parameters. But the firms that have traders who are working within that model, they pay really close attention to, and they think a lot about risk. And one of the observations that they have is that if you look at daily P&L numbers and you try to predict tomorrow's P&L based on today's, you're basically looking at noise. Like, it's a coin toss. There are people who are like, if they're working as professional money managers, they're probably slightly profitable over time, but on any given day, they're pretty big swings. And So you can't really predict next day P&L from previous day's P&L. But if you look at volatility, that's not true. It's actually very, very likely that if today was a crazy day, that tomorrow will either be an even crazier day or a slightly less crazy, but still crazier than average day. It takes a while for volatility to return to normal. And sometimes there are these serially correlated spikes where today's volatility causes so much craziness that tomorrow's even crazier. Like that's part of what you saw with the financial crisis was basically every bad headline was also bad news that would ripple through the system and cause the next day's bad headline. Um, and so if you're operating in that situation, if you know that your risk just went up, then the optimal thing to do is actually reduce your exposure because you're trying to hit a steady level of risk. So if like the day-to-day volatility doubles, you want to cut your position size in half. And if you have been a good, diligent hedge fund portfolio manager, one of those positions is probably Nvidia and one of them is probably TSM. And there are other AI plays that are, I think they're old news at this point, but exciting news today. But you're cutting all of those positions, and then if you are running a market neutral or factor neutral book, you also have short positions. You're exiting those, so you're basically pushing every asset in the opposite direction of what trade you had on. And if a lot of people have on similar trades, they all lose a bunch of money, and then you have this problem recur as people lose money not just because Nvidia went down on bad news, but because Nvidia also went down on the fact that some people who had Nvidia as their largest position no longer have jobs. So um, when hedge funds have these risk models, and this is a piece that will be out by the time this episode is published. When they have risk models, they are trying to capture different risks because what they want to pay people for is actual asset selection, and what they don't want to pay people for is having locked into the right position. Where if your job happens to be pick large cap American growth stocks, you have a really amazing track record, even if within those companies, you always pick the worst ones. They've all gone up. So at a lot of funds, you generally just don't get paid for that, or you don't get paid very much for doing that kind of thing. What you get paid for is the within group selection. Now, on a day like today, what you would expect if the risk team is saying, okay, it looks like you have a lot of exposure to AI, you need to offset that exposure. You need to have bets against AI. Then what you'd expect is a bunch of AI stocks would be way down, and then a bunch of other AI stocks would be way up. And you don't see that at all. What you actually see is basically everything with any kind of theoretical exposure to AI went down. You have the actual mainstream, directly exposed companies like Nvidia took a huge hit. TSM took a hit. And then as of this morning, Meta was down. Meta's up now because DeepSeek does reduce their costs. It's good for them in the short term. There's some other issues longer term. But and there were also companies where they're just like a more dodgy kind of weird bet on AI. Like there are companies that have a lot of exposure to just data centers generally. And if there are more of them, these companies do well. And for some of these companies, they're not great businesses. Like occasionally there will be boom times. They will issue a lot of stock that keeps them alive during the usual fallow period where they're just not making much money. But on today, the companies that are in that bucket for me, they're also down. And then, there was this utilities trade where one of the bets was an actual economic bet. It was AI increases the amount of power consumption in the US. It increases the part of the economy that is just turning watts into money or turning watt hours into money. And that if that's a larger part of the economy, and if we can build, baby, build, then utilities will do well, and utilities are also not especially volatile. So the other part of that trade was just from the perspective of hedge fund risk management. You just apparently had a lot of permission to take pretty massive positions in some of these very, very stable, very regulated utility type businesses or utility adjacent businesses. And one of the features of a business like that is, okay, if you have a business where it's highly regulated and its revenue is very regulated, that revenue is regulated based on cost, which is roughly true. The utilities are actually pretty good at gaming this stuff, but that's a separate conversation. If that's true, then the price of the asset is not going to be super volatile. Like utilities are kind of a substitute for bonds. If you want to own bonds and your mandate is own stocks, just buy utilities instead, is kind of the given wisdom. But that also means that their asset, their value on in terms of standard deviations is actually really, really sensitive to any change in growth assumptions because the growth assumptions are so locked in. So you actually get a ton of upside and you can lever up a position like that pretty substantially if you find some reason that utilities are either going to do really well or really poorly compared to expectations. So a lot of fund managers were apparently doing that. There was actually an article in the Wall Street Journal about how this is the trendy trade, not because the utilities are the biggest direct beneficiary of AI, but because it was kind of like a regulatory arbitrage where the regulation in question was risk management. My guess is that the risk managers who did not get fired today are going to be a lot more careful about coming up with kind of thematic ad hoc factors, such that if you're betting on some big trend, whether it is AI or deglobalization or crypto or a war or whatever, that you do actually have to have offsetting bets, even if that risk factor is not on the standard menu of risk factors. So, and another piece of evidence for the fact that some of this trading is just driven by levered investors unwinding because they're following pretty reasonable risk policies is that if you look at ETFs that try to hold a basket of momentum stocks and just look through their holdings and look at quotes for some of the momentum-y stocks that they had nothing whatsoever to do with AI, you actually see that a lot of those companies did pretty well today. So there were a lot of people who they were long Nvidia, and their risk tool tells them, okay, you need to be short something that is high momentum and it's a high margin company and it's putting up decent growth, et cetera, et cetera. So they were short stuff like TJ Maxx or Philip Morris or like Progressive Insurance. So like you can definitely tell stories. Like I'm sure there's at least one person who thought that today was the day they were going to quit smoking, and as a result of the market action or as a result of DeepSeek, they're going to quit smoking some other day. But and yeah, maybe someone is trading down to cheaper apparel. But for the most part, what's going on is that people who are shrinking the overall size of a long short portfolio, they have to buy the things they were short, and those things were high momentum stocks that were not involved in the AI trade. So yeah, I think what we are seeing, part of why the market is so exciting today, is that it's an unwind of a trade that I think everyone kind of knew that everybody else had on, but didn't know the exact details. And it does turn out that sometimes when you are doing some kind of pair trade because you have a risk you want to take and then a risk you're indifferent to taking, if everyone is indifferent to taking the same risk, then that side of the trade can actually move more. This, again, was something that happened in the financial crisis, where one of the results of the financial crisis was that all of the funding currencies and carry trades, in other words, the low interest rate thing you borrow in order to lend in a high interest rate currency, those things went up massively. Great time for the dollar, great time for the Swiss franc, et cetera. Some of that is just people wanted their assets denominated in dollars. They wanted to own dollars, but some of that was they had been basically short the dollar, and they hadn't thought of themselves as being short the dollar. They thought of themselves as being long, I don't know, Brazilian real or something, but they were in effect also short the dollar, and that side of the trade also moved against them. So that's part of what I've been thinking about on the market side. And then on the technical side, it's DeepSeek is it's really impressive. Like I've been reading and trying to read with the most skeptical eye that I can, like trying to find the case where this paragraph would make a whole lot more sense if you secretly had way more GPUs than you say you do. And I guess you can kind of lean in that direction. Like I have not personally trained a model myself. I don't know for sure what the constraints are, but I do just see a lot of clever optimizations around some of the hardware limitations that they had. So that's the first order thing. It's like they did a good job. Like it is a good model. It's fast. It seems to work great. I think that one of the second order questions is just, okay, where does this leave the American companies? And one thing that it leaves them with is a really cheap model with open weights that they can just run on their own hardware. So for companies that are AI users, this is just one of their key inputs got a little bit cheaper, and that's great for them. For companies that are also making AI tools, if they're making wrappers, again, they switch which model they're using, or maybe just get better at toggling between models. But for the companies that are actually training their own models, it's more questionable. But my understanding, and this is just from public news coverage, is that the companies that do that are scrambling. They are trying to learn everything they can about what DeepSeek did and how they can do it themselves. And I don't think it's all that likely that the US companies will not at some point, probably quite soon, catch up. And when they do, they catch up, but they have a lot more hardware, and they are in a market where there is more total AI talent. Like DeepSeek does seem to have just a really incredible team, but they also have a team that it's a finite number of people. And the US just does have a really deep market for this particular kind of talent, because we've been doing this kind of thing for a bit longer and have been putting a lot of resources into it at a bunch of different companies. So I think that if catch-up growth is possible, it's going to happen. If it happens, the U.S. will end up with parity on the software level and a massive advantage on the hardware level. And of course, we have all these other advantages, like if you're starting an AI company and you started in the US, you're way more likely to get good funding and you're way more likely to find the people you want, both on the research side and just every other position that you'd want to hire for, just like super liquid labor market. So I think that this is probably um, probably not a huge problem for the overall AI bull case, but it does change the contours of that bull case a lot. It does mean that there are some companies where, like, part of the reason that Nvidia was such a popular stock was you could be pretty agnostic on a lot of important AI questions. You could say, I don't know whether distribution or model quality wins. I don't know whether OpenAI or Anthropic or Llama or Facebook will produce the best model. I don't know any of that, but I know that whatever is going on, it is going to cause more GPUs to be ordered from Nvidia, and maybe that is actually less the case than it was before. But also, if the U.S. is in a capital abundant environment, if a lot of these big tech companies have already locked in their capital spending guidance and they've already put in the orders, they're trying to catch up as quickly as possible. Well, historically, the easiest way to catch up in AI is, as annoying as this is, it is just throw money at the problem, turn that money into hardware, have smart people use that hardware well, but the actual, like, the thing you can scale the most trivially is just the dollars you put in. And the companies that are investing in AI, they have pretty ample financial resources. Like they are not hurting for cash. Meta could be spending a lot more money on AI if it really felt like that were necessary. And if they end up spending a ton of money in a panic to just achieve performance parity, and then they also are able to replicate some or even all of the optimizations that DeepSeek has done, at least the ones that are relevant, given different hardware constraints for the US companies, then they actually end up ahead. It's just a terrifying process to get there.
Hey everybody, Erik here with a word from our sponsors. Most of you probably know how much the Turpentine team loves Notion, the sponsor of today's episode. We use it every day for editorial planning, transcript markups, project managing, knowledge sharing, and it's where I drop random 3 a.m. ideas that turn into episodes. Now it has the power of AI, built right inside of Notion and woven across our entire workspace. It's been a total game changer for our productivity and focus. We just used it the other day to architect the content schedule for next month across our network. Notion combines your notes, docs, and projects into one space that's simple and beautifully designed. The fully integrated Notion AI helps you work faster, write better, and think bigger, doing tasks that normally take you hours in just seconds. Try Notion for free when you go to notion.com/upstreampod. That's all lowercase letters. Notion.com/upstreampod to try the powerful, easy to use Notion AI today. And when you use our link, you're supporting our show. That's notion.com/upstreampod.
Trust isn't just earned, it's demanded. Whether you're a startup founder navigating your first audit or a seasoned security professional scaling your GRC program, proving your commitment to security has never been more critical or more complex. That's where Vanta comes in. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like SOC 2 and ISO 27001. Centralize security workflows, complete questionnaires up to 5 times faster, and proactively manage vendor risk. Vanta can help you start or scale your security programming by connecting you with auditors and experts to conduct your audit and set up your security program quickly. Plus, with automation and AI throughout the platform, Vanta gives you time back so you can focus on building your company. Join over 9,000 global companies like Atlassian, Quora, and Factory who use Vanta to manage risk and prove security in real time. For a limited time, listeners get $1,000 off Vanta at vanta.com/revolution. That's VANTA.com/revolution for $1,000 off.
This information is fascinating because it sort of challenges some long-held beliefs people have had in this space, long-held at least in the past few months, around, hey, there's going to be no new entrants because the existing companies are just so well funded and so far along. We're not going to see anything new. When in reality, we're probably early. And then also, China's so far behind. They're not going to compete, et cetera. And this challenges both of those.
It does. And the China thing has been the biggest surprise to me, because I did think that one of the bottlenecks is hardware, that China has a lot of great engineers, a lot of great researchers, tons and tons of data, and lots of companies that have aggregated that data already. So I thought that if the US does want to win an AI race with China, that really the only lever that the government has to pull is making sure that China can't get access to the hardware. And again, I do want to emphasize that the US still has an advantage on the inference side. And you do want to do that in the US or a US aligned country and not in China, because you can get more efficient chips and you also just make more money from a given token. So even if this is actually the end, like no one ever ships another model, and these are the models that we have, that still means that the models are cheaper. Like that is net good for anyone who wants to use this, and it's net good for overall productivity growth. And we still have the same, turnover in the labor market, some job disruption, some job creation. We'll see how it goes. There will be all kinds of political issues. Like even just taking AI technology as it exists right now and deploying it is still a big deal. Very disruptive process, will lead to a lot of growth and a lot of tough decisions in the meantime. But if it continues, then there is the question of how would someone like DeepSeek scale from here? And there's also the question of how do other people take the kind of existence proof and scale it if they're subject to far fewer constraints on a lot of the relevant axes. So yeah, the China thing, it is interesting. It is surprising. It is a good reminder to just stay on your toes. Like there's more than one protagonist out there and more than one live player. And yeah, I think on the other piece of just AI consolidating and the barriers to entry going up, I still think that's directionally true. Like I still think that's the direction to bet in for many new technologies. Is at first there are tons of new entrants, but eventually there is some kind of barrier where you need to be at a certain scale before you can participate at all. And over time, those barriers to scale just naturally go up and up and up. Like if you look at consumer facing apps, there was a time when the really easy part was just acquiring lots of users. Like once you had an app that worked, once you had a concept that made sense, you could onboard tons and tons of users. There were lots of really cheap ad inventory just all across the web, and a lot of it was on Facebook. So just turning Facebook ad budget into DAUs was a pretty well-known part of the formula. But over time, those ad units have gotten pricey because it is such a good way to acquire users. And so now if you have some product where it has some level of network effect, like it is a better product with 1 million users than it is with 1,000, then you actually need to spend the money to get that 1 million users. And if the product is hypothetically better with 1 million users than with 1,000, but you need a lot of data to figure out how to get user retention to the point where you actually keep your 1 million users or are able to keep 1 million users around, then you have to spend that money acquiring users over and over and over again until you get the formula right. And this is something that I think if you a couple years ago had made this case about social media saying there aren't that many new entrants like Pinterest, Snap, these are actually pretty old companies, even though they are challengers to some other players in the space. So you could have made that argument. And then TikTok was able to surmount this problem. They were able to enter a mature industry where it looked like all the players have been established. And one of the reasons they were able to do that was just they kept spending. They spent a lot of money on user acquisition and had horrible retention for a long time, but that retention kept getting better. And I think they were just confident that at some point things would click. At some point they would retain enough users who are making enough videos that it gets easier to acquire the next cohort of users. And once you get past that J curve on the ROI of acquiring users, where your initial users, when it's just a lip syncing app, like you trivially acquire the small set of users who just want a lip syncing app. And then as you turn it into more of a video sharing app, over time, it actually gets worse and worse for your original cohort of users. And it's very expensive to acquire the next set of users. But eventually, TikTok had this formula where they realized the best performing ads were just weird videos on TikTok that were popular. And if that is the best performing ad unit you have, then you're in a really good position because you actually get better and better ads as your product scales. And the fact that TikTok also put its logo on all of its videos, and it meant that even if something went more viral on Twitter or on Facebook than on TikTok, that it was still putting the TikTok brand in front of a lot of people. That also increases the return on investment from ads because now people are clicking on a familiar brand name instead of some weird thing they never heard of. So you do have cases where an industry matures and the barriers to entry go up, but because the barriers to entry go up, there are actually fewer new entrants that is economically viable because there are just fewer people willing to take that bet. And if you are the one person willing to take that bet, you can run away with whatever part of the market the existing incumbents weren't paying enough attention to. And then this is something presumably totally different, where it was a bet that a different barrier to entry could be overcome. In this case, the barrier of not having access to the best hardware. But if you don't have access to the best hardware, but you do have access to a lot of talent, and you are backed by some patient capital, it may not be a coincidence that the best open models out there right now are either A, subsidized by ads in your newsfeed, or B, subsidized by the profits from systematic trading. So in neither case is it that the AI model is directly relevant to the core business, but in both cases, there's a lot of complementarity between the skills required for the core business and the skills required for this other thing.
Yeah. And then on the China thing, again, in terms of the competitive angle, some people are saying, hey, maybe there's been a sort of violation of export controls here. We're not exactly sure how this was put together. And other people are saying, hey, regardless, America has to keep innovating and has to find a way to prevent, others from copying and going stronger in the same way that, Facebook copies other apps and just does it better.
Yeah, I think it's fine to sometimes be the fast follower. And I think this was there was definitely a period where it felt like, and this is something I actually wondered about, because it felt like maybe 5 to 10 years ago, there was actually significantly more innovation and just a much faster pace of shipping in Chinese consumer internet than US consumer internet. It felt like those companies were actually more aggressive. TikTok was definitely not the only one. And that if you looked at a screenshot of, say, WeChat every 6 months, like you'd actually see things changing over time, and you could see the business evolving in a way that you wouldn't see with Facebook or Twitter. And I haven't really heard nearly as much of that since then. I think the closest that I heard is US companies periodically taking a run at turning social shopping into something in the US, where it's really big in China and it's really big in the US, but the specific demographic in which it's big in the US is basically women 70 years or older who still watch QVC and HSN. So like that model, and it's not a purely age-related thing. There's a particular demographic cohort that was watching a lot of cable TV at the time when QVC and HSN first launched, and ended up being part of that ecosystem, like ended up being repeat customers. And those home shopping channels just got so good at getting an incremental dollar from their existing customer that it wasn't really worth it for them to invest in their next customer. And then you fast forward 30 years and their customers are dying. And so the businesses are dying too. But it does feel like there should be something like that in the US. And there have been different efforts to make it happen and make it big. It seems like it's just not as big in the US. And it's very unclear why that would be. But I don't know of how many other consumer-facing innovations in the Chinese ecosystem are actually being actively copied in the US compared to a few years ago when it was just a big thing. So it could be that there are just different epicycles within each cluster of companies, and sometimes there's a lot of experimentation and iteration. Sometimes you just get to this local maximum where it's really, really hard to find the next cool thing. And it's also really expensive because to find the next good thing, you pay the opportunity cost of not monetizing the current cool thing as much. So Meta does this sometimes, like they did this with Reels, where they were willing to forego billions of dollars in ad revenue in order to get to scale on short video. But many other companies just aren't willing to take that kind of risk.
Yeah, it is interesting. Well, just while we're on the Meta topic, I wonder how they're viewing Threads internally. There's sort of the Twitter competitor that they were leveraging the Instagram growth and graph to build up. And my sense is that it's somewhat big, but probably not making a dent either to Meta or to X. And so I'm not sure if they would do it again. I'm curious if you have an immediate reaction.
I think it's probably better for them to have a portfolio of pretty good alternatives to a lot of products, or like a set of features that mimic a lot of what else exists out there, because they are trying to build infrastructure for social interaction online. And to do that, that means you need to identify every kind of social interaction that you think is tolerable to have on your site, and then find some way for people to do it on that site, or some way for third-party products to integrate with it. And so for things like dating, it does feel like Facebook has basically said that even though it started out as very much a dating site, like you can't give a bunch of 18 to 22-year-olds a way to contact the person they saw in class and have it not turn into a dating site. But I think they've decided that it's hard to make that compatible with everything else that they want the product to be. And meanwhile, there are other dating apps out there that can still, import photos from someone's Facebook profile or whatever. So there's still some kind of connection there, but the actual activity is happening elsewhere, which does mean that Facebook becomes infrastructure. It becomes just this default thing where everybody's got it, and therefore it's really hard to rip out. Like, the network is very durable. For Threads in particular, I kind of can't tell, because at one level, it did seem like this really bold, almost piratical thing to do, where that a lot of Twitter users are, for the very first time, considering going onto some other platform. But the big question is, if there are 50 different platforms that each get 0.1% of my friends, then I have 50 different places to be lonely. I need the platform with all of my friends. And Threads was like, yeah, we actually have that. Like, you all have an Instagram, you all have a Facebook, even if you are embarrassed to say that you still check it from time to time, or even if you only use it for the marketplace feature. Like, you're all already here. You just want this kind of thing to be here. You want a feed of mostly text, and like text by default, but also images and videos. And I guess for a lot of people, the network effect was just not. I think the Twitter network effect was too strong. And Twitter, there's a layer of the network effect that I think is underappreciated, which is that what Twitter allows you to do is, anytime there is any kind of breaking news, you get to spin up a miniature social network that is centered around exactly that topic. It is just like there are all these long tail forums that have been mostly eaten by Reddit, Pinterest, etc., and Facebook. But there used to be just a forum for pretty much every topic. And Twitter basically lets you have that, but it's for whatever is happening right now, where there's just not time to aggregate the community. But you just search for the relevant term, and you find people talking about it, and you can talk to them. And if you search for that relevant term on Twitter and on Threads, and Twitter has people talking about DeepSeek, for example, and Threads doesn't yet, or the first thing you see is not quite interesting enough to reply to, then you will default to the bigger network, to Twitter. So it's kind of like the economics of ride sharing, where they just need to be like Lyft. It's a really bad situation for Lyft if people know that Uber is probably going to get there 2 minutes faster, because that means people check Uber first. And if they're sufficiently habituated to checking Uber first, at some point they will respond to Uber's push notification telling them to sign up for the loyalty program, and then they only check Uber. And I think with X, it's less about obviously there is a sort of X loyalty program, which is basically, do you like Elon enough to give him $8? If so, he will give you a little bit more attention and show you slightly fewer ads. But I think it's less central than just people know their friends are on X. They know that the relevant group chat is happening on X, and so they know that X is the first place to check. And once it's the first place to check, it's the first place you post. And once it's the first place you post, it's the first place everyone else checks. And so that kind of continuously recreated miniature network effect is really, really hard to disrupt, because the news junkies were the ones who did not want to switch from X to Threads, because they knew that being a few minutes late was actually going to be just intolerable to them. They were addicted to the real-time nature of X, and they're also the people who are maintaining that exact network effect for everyone else.
Yeah, it is interesting. There was this one interaction where someone was criticizing Jan LeCun. Jan LeCun responded on LinkedIn, and then someone said, Jan, come fight me on X, you scaredy cat, or whatever. Like, this is the actual arena, as opposed to the sort of secondary arenas. Blue Sky is having some, in thread, like some, it seems like newsmakers have shifted. It's like a left wing Gab or Parler, but more successful than the Gabs or Parlers. And yeah, I think that all makes sense. I think at higher levels, I wonder if the mental model for X it's a bit of a loss leader for Elon's other projects. I of course, gaining more influence in the administration, but also, Grok and XAI. And I wonder if just kind of the size of the audience that X is now will be the size in perpetuity. And, there'll be some, fragmentations like Blue Sky and, Farcaster with crypto Twitter, and, some of the use cases that Twitter used to have maybe sports, for example, will, silo off, and X will just be the politics and news or mostly the politics and news app, with the slightly right wing bent. And maybe Elon will figure out how to make more money from the existing user set. Maybe not. Maybe he doesn't need to. Well, they did raise a lot of money, so people they want to. But yeah, I'm curious if you think that's the right mental model of what's likely to happen, or how do you think about it?
Yeah, it still feels like Elon's flailing a little bit with just what is the long-term model of X supposed to be. So there was a story in the journal late last week that some of the banks that made the original loans to X are trying to sell off those loans. And so the Bloomberg headline that they are apparently also selling off some kind of exposure to XAI in addition to those loans is kind of a sweetener. And this does tie into the general Elon model of just having lots of different projects and different assets such that there's always something that's pretty cool. So if there haven't been any interesting new Tesla product launches recently, SpaceX has probably done something interesting, and now X has probably done something interesting. So there's always some source of hype, and Elon is just really good at gliding on hype. So the more sources of it he has, the better off he is. I really don't understand what the end game for X is. It was pretty interesting to just as like an active performance art to demonstrate that you can actually cut like 80% of the staff of some large mature service and the service will actually keep running. It feels like there are fewer bugs than there were in the first couple weeks where things did seem a little bit hectic, a little bit dicey. There are still occasionally bugs. It feels like a slightly worse product or slightly less reliable product than it was pre-acquisition. But if it's also a much cheaper product to operate, then that's probably a net economic gain. And yeah, the influence thing, it's hard to discount that. It's possible that was a deciding or even the deciding factor in the election, because despite like in some ways large mandate, in some ways it was a large mandate that consisted of a finite number of small-ish swings in different groups of voters that did tip the election in one direction. And Twitter seems like a good place, as good a place as any to engineer that kind of swing. And this gets into I think a lot of questions about just bias and moderation. It really depends on where you're standing. So I think from Elon's perspective, Twitter used to be biased against the right, and he moved it towards being more centrist, and that did cause this rightward shift in the electorate. I feel like we won't even, not only will we never get the full story, we will definitely not get the story from Elon, because even if he has socially awkward moments, I think he is aware that if he tries to take personal credit for Donald Trump being president and this ever gets back to Donald Trump, that he has lost all of the upside that he got from making that happen. So he has to be a much more humble person than I'm sure he's inclined to be, because he has found a larger ego than his, and is in that ego's presence a whole lot the day. So the other perspective, which I think is a very popular perspective on Blue Sky and Threads, is that no, Twitter was actually very, very centrist. It's just the right was misbehaving, the left was less misbehaving, and Elon switched to favoring the right, which only looks fair and balanced if you are a Fox News and Breitbart addict. And there's not a good answer. Like if there is a true, totally detached centrist, then I'm sure they could give us their views. But I don't think such a person actually exists. I think everyone's going to have biases, so everyone is going to say that no, there's one version of the moderation was fair, one version is biased, and it's going to be very easy to predict which is which. But I think it is undeniable that Twitter's moderation approach moved to the right. It became a friendlier place for people on the right, and it is still a place where narratives get formed, where narratives get shaped. There is this direct path from people tweeting they're eating the dogs and cats to that being said on the debate stage, and that's maybe that tweet would have gotten taken down as disinformation if Twitter were under previous ownership.
Yeah. It's fascinating how I wonder if you don't have to comment on this, but if June 2020, if Elon had owned Twitter, if there would have been the same sort of protests in the streets, after George Floyd's passing, and basically how much the ownership of Twitter matters in terms of what gets seen, what gets amplified, because the old regime was doing a lot of censoring. The new regime is doing a lot of highlighting. Or Elon himself, just as a individual user, the biggest user on the platform, is doing a lot of concerning, interesting.
Right. And I think this is the sophisticated right-wing critique of media bias in the mainstream media is not that they are outright lying and fabricating things and they will never tell you the truth. No, it's that actually the New York Times is just chock full of accurate, factual portrayals of what's going on in the world. And you just have to read through like the first 60% or so of the article to find the key thing that actually makes this story make a lot more sense. And I think that's also just I don't think that this has to be organized in some conspiratorial way. I think this is just a natural way for people to talk about things and to slightly shade the narrative in a way that favors their side. And in fact, part of the difference, like part of the way that political bias is expressed is in which issues are salient. And so if you talk about immigration, if you bring up immigration in a political context, you're making an implicitly right-wing, you're implicitly being right-wing, even if you don't say anything that is factually untrue, because immigration is an issue where the Republican policies, at least like the middle of the road Republican policies, not necessarily the Trump ones, but like the middle of the road Republican policies have more national popularity than the Democratic policies. Now, if you bring up healthcare in a political debate, you are probably not bringing it up in order to make Republicans look good. And Republicans will often go out of their way not to talk about healthcare. Or if they do talk about healthcare, they talk about how great it is that America has so many companies that produce such amazing medical technology. They don't talk about just the cost to the average person of getting healthcare, because it's quite expensive here. And we have a different system for paying for it than other places, for better in some cases and for worse in many others. And so just being totally neutral, but choosing which stories make it to the front page and which details are in the headline and which details are put later on, that is a form of bias. It is one that can shape people's viewpoints. And I think it's one that, that the editors of the New York Times have and that Elon also has.
And this is a segue to this Ross Douthat article you linked to in your long reads, which is an interview with Mark Andreessen about the vibe shift to the right. By the way, I was with my friend Yasha Monk this past weekend, and I was trying to convince him that his next book should be on the vibe shift, because I just think this is an interesting period of time. And anyways, one of Mark's sort of hypotheses is he's like, hey, maybe maybe people don't have strongly held views at all, and they kind of most people kind of just go wherever their bread is buttered, so to speak. Go to wherever it's convenient to be. And they were left when it was convenient to be left, and now they're right when it's convenient to be right. And so maybe there will just continue to be a little bit of this ping ponging as different factions are in power.
Yeah, I think that's absolutely true, and in some cases that's true in this totally mercenary sense that if you are a CEO and you're a fiduciary, you take your fiduciary duties seriously, and maybe you take the political process a little bit less seriously, like you should be pretty excited about whoever is in office. You should be glad that you supported them and glad that you endorsed them and really glad that they won the election and really anxious to talk to them about policies that might affect your business. That's good business. And so that version can be pretty cynical. It could also be the case that this is just part of the marketplace of ideas, is that CEOs just have access to a lot of information, and their job is to aggregate the interests of all of their stakeholders, of the shareholders and employees and customers in whichever order you choose. And maybe you choose different orders. Maybe, the order you choose depends on which discount rate you're applying. So, Amazon, famously customer centric, has been a pretty decent business for the shareholders, and plenty of employees have gotten rich. But if their default attitude is let's at least try to do, or at least seem like we are doing whatever's best for the customer, that ends up making everybody else better off too. So these CEOs are aggregating a bunch of these interests, and they are sort of representing them. It is in a way, it's not democratic, but actually what it is an echo of the Leninist concept of this democratic centralism or something of that nature, where this is something, whatever the term is, the CCP actually uses it to describe their system, which is basically, no, you can't actually vote in a way that matters, but you can complain in a way that matters. And not only can you complain to the mayor of your town, but you can complain one level up, and we will always pay really close attention to those complaints. So there's always this weird leapfrogging anti-censorship dynamic in China, where the central government does not want to be criticized, but the central government really wants the provincial government to be criticized, because that's how they know which provincial governments are messing up what. And you have the same kind of iterated thing one layer down, where provincial government really doesn't want to be criticized, but it really wants the local, like the mayors, to be just ripped to shreds in local newspapers if they are actually doing something illegal, corrupt, stupid, whatever. So this is just another instance of that. It is a weird evolutionary convergence between a communist dictatorship and a capitalist democracy, that the CEOs are actually unusually well informed. If they are CEOs of large important companies, they're not just well informed, but they're actually well informed about the specific fields in which the US has a competitive advantage. So yeah, it does actually make sense for them to play some kind of role. And then there's going to be a lively debate over just how much of a role they play and how much power they actually have, etc. But it's a debate we can have a separate time. So there's that piece. And then the other piece of just getting along with people and having kind of agreeable politics is that for a lot of people, politics is just not that central to their lives, but acceptance of peers is actually pretty important. And so sometimes people just kind of, as political priorities drift, people's opinions also drift. And if you look at things like charts, long-term polling data on approval for gay marriage or interracial marriage before that, there don't seem to be any real catalysts or huge jumps, other than with gay marriage. A lot of people decided it was okay once the Supreme Court said it is the law of the land. But there's just this gradual shift. And it's a process, and it's a process of people slowly changing their minds, and also people just slowly taking the temperature. And as the issue gets more salient, you do find that people start actually advocating things more, and they start talking about these things more, and they start having firmer opinions. Whereas let's say it's 1970, having an opinion on gay marriage is just an incredibly weird thing to do. Like, it's not on anybody's radar, and gay rights groups were pretty indifferent to that as an end goal. It might have been a hypothetical they talked about, but they weren't trying to pass laws or anything. It was just so far away from where they were at the time that it didn't even make sense to have an opinion on that issue. And at some point, like over my lifetime, believing that gay marriage is okay went from actually a minority viewpoint and a somewhat vilified one to a completely mainstream one, where it is actually a pretty outlier opinion to be even somewhat skeptical. So these shifts they happen over time, and it's very hard to model that process. But that also means that it's not as if there are these discrete events that persuade people. There's just there is kind of mimetic competition. There are some memes that are going to spread faster than other memes, and sometimes that is a totally viral thing, like jokes. Jokes are a classic meme. They spread because they're funny, but they don't have any real selection effect beyond that. But calculus is also an incredibly viral meme. Like, every country that gets exposure to it ends up using it and ends up teaching at least some of their kids how to do it. So it's very viral entirely because it actually improves, not because it itself is like this really compelling thing you just can't wait to talk to other people about, but because it actually leads to better outcomes. So you have that mimetic selection thing going on. And the thing that I highlighted in that interview, because I thought it was really interesting, and actually more interesting if you abstract away the details, is Andreessen had this claim that tech companies were not, they had very progressive policies, but it wasn't because they were insanely progressive at every level. It was that a small number of employees were very politically active and very progressive and pretty well coordinated. And there was a large number of employees who, net lean progressive. They were probably going to vote for a Democrat, and, might have considered someone like Mitt Romney, but probably wouldn't have made a big deal about it if they had voted for him. And that if you have an environment like that, it is the people who are really, really political, who are also going to have stronger political views, who set the entire agenda. And there's also, I'm sure that there's a small cohort of people who are very political and very right-wing in these companies, and they are also shifting that agenda in a different direction. And the median person's views can shift just a tiny, tiny bit from being like 55-45 Democrat to 55-45 Republican. And suddenly the average view in the company, if you're just measuring, is it net, are there more net Republicans than net Democrats, it suddenly shifts in the other direction. So I think we can overestimate the magnitude of the actual underlying shift in views, and even of the number of people who've changed their opinions because of that dynamic. And then the other piece that is really important to remember is Donald Trump really likes compliments. He is just a big, big fan of people who are big, big fans of him. And So it just pays a lot better to be effusive when talking to Donald Trump. I was reading a quarterly call, like an earnings call transcript from an airline, and the airlines do this thing where they do their just prepared remarks, and then they have questions from analysts. But the airlines will also have a section at the end where they have questions from journalists, and it's only when the journalists were talking that that politics really came up. But this airline, the CEO went out of his way to say, we look forward to collaborating with the Trump administration. He didn't use that term. It's a little bit fraught. We look forward to working with the Trump administration, and we'd just like to thank Donald Trump for rescuing our industry in 2020. And, we're the only reason we're here today is because Trump understood how important airlines are, et cetera, et cetera. Like, you didn't say that about Obama. I don't recall any conference calls from banks in 2009 talking about how Obama just completely saved their business, even though it is true that they received substantial assistance from the US government and that Obama signed off on a lot of that. But I think one of the reasons for that was just you didn't really need to. Like, Obama is he's able to he's part of like a totally different class structure and like a totally different reputation structure than Trump is. He's a scripted TV guy. Trump is a reality TV guy. And so the reality TV guy, like, there needs to be some action, some excitement, and some real characters and personalities. And that was just less of a thing during the Obama years. And it was also kind of a broad assumption that a lot of people pretty much got along with Obama. He was a reasonably high status guy to support.
Yeah. Well, speaking of plays at Trump's affection and heart, let's segue to Stargate, which is surprising. One, because didn't expect to see Sam Altman so ingratiated in Trump's administration so early on, given the Elon connection. But then we also didn't, just the amount of money that they're talking about. With Elon saying, hey, less than 10 billion is secured from the SoftBank angle, also, lets people to believe, hey, this is a lot of debt happening, or this is more of just a prospectus. But what were your reactions?
Yeah, it felt like what they were really doing was indicating that they are willing to make a large long-term investment in AI, that they want it to be at least a somewhat economic nationalist project, not in the sense of OpenAI is always and exclusively going to defend U.S. interests, and it's going to be as politically aligned with the current administration as Russia today is with Putin or whatever. But it was saying like they do understand that this is a national strategic priority and they want to make it happen. And yeah, you had this mix of participants who none of whom, like all of whom together, do not have enough capital to hit the 500 billion number or even the 100 billion number. Although I'm sure they will collectively be able to raise at least the 100 billion. We'll see. We'll see what Nvidia does tomorrow. But my guess is there is still appetite to back AI investment, and that there's still going to be money flowing into the sector for a while, even if the pace is a little bit disrupted. But also, when you announce a big investment like that, part of what you're doing is you're saying, if you are going to build something that uses OpenAI's APIs, you should expect to get cheaper and better stuff. Like we're investing a lot in the infrastructure that allows us to do cheaper inference, allows us to train bigger, better models or smaller, faster models. And so, he's telling everyone else in the industry to get more ambitious, but he's also telling everyone else who's considering infrastructure projects that there's going to be a lot of competition. There's going to be a finite number of GPUs, even though it's a lot, and that there is going to be a big bidder in the market who wants to buy them. And that once those GPUs are in place, once the models are trained, there's going to be some market clearing price for tokens. And that price is going to be set in part based on just competition between different companies providing roughly similar models with slightly different capabilities. And if you pre-announce this huge investment, then you are just, you're getting rid of some set of future competitors. You're making it harder for them to raise funding, and you're making them a little bit more reluctant to invest a huge amount of money in what could just be some stranded asset that doesn't get a great return. And this is actually, I think, part of the SoftBank strategy. So SoftBank would sometimes find a company that was trying to raise, say, $50 million. They'd say, you know what, your business sounds really, really good. How's 300 million? And I think part of what they were doing was they were ensuring that no one else in that sector could possibly raise remotely similar amounts of money to do the same thing. And so if you look at like a dog walking startup, they put a ton of money into one of the dog walking startups. I forget which, but they did. And it just made it hard for anyone else to raise a lot of money for a dog walking startup. And that startup did burn a lot of that money, but they were acquiring customers, they were building up their two-sided network, and they were right that there was actually a market for this. So um, if you make that kind of huge investment and you also structure it a little bit, like once you do that, the company's biggest asset is the cash that you just gave them. And if you have a liquidation preference and you are telling them you're able to exert some control over the pace at which they burn money, maybe you tell them like, okay, spend the first 100 million as quickly as humanly possible, get as much share as you can, but then we're going to revisit our retention metrics. We're going to also look at what your market share is in the cities you've launched in, and just ask ourselves, like, is it actually realistic that anyone else is a serious competitive threat? And if the answer is no, then you can dial back the spending, and now you have a company where, yeah, they have excess cash on the balance sheet, but when you are valuing that company and when you're considering the risk in that company, you also treat that cash as a backstop. Like, you value the business X cash, you're looking at enterprise value, not market cap. And so you end up with a slightly less volatile portfolio where if that company does get bought, then that cash is just part of the acquisition premium. And so you do eventually get it back. So in that sense, it is a very risk-seeking strategy in that it means finding money-losing startups, writing giant checks to them, asking them to lose money faster. But in another way, it's a risk mitigating startup. If your concern is a lot of people could have this idea and whoever spends the most money first will probably win, then at that point, your opportunity cost is very high if you don't spend as much money as you can conceive spending.
And I wonder if this is just a vote of confidence for OpenAI being able to figure out this for-profit delineation, because my impression was that there's some, sort of ticking clock that if they're unable to figure out how to convert, then they have to give all this sort of, it unwinds a lot of their previous fundraising. And then, it looks like that it's like, game over for them to some degree.
Could be. I am less familiar with that, and also somewhat less confident in that. It does feel like the kind of thing where your lawyer has to be either very, very, like, you have to be really, really risk tolerant, or your lawyer has to be really, really bad to set up some kind of structure where, yeah, you actually have to give Microsoft back tens of
not Microsoft. I think it's Thrive.
Thrive does. They get it back.
Yeah, but I'm not. I shouldn't be speaking so confidently about it. That's just what I heard.
No, it's also possible. Like, this is, structure is a thing that exists in venture deals. And the reason it exists is there are different risks that different sides want to take. And sometimes they have a valuation gap because they have a different estimate of the probability of different outcomes. Like, this is the classic defense, which I think is true of high liquidation preferences, like a 2x liquidation preference. So, that is, if I put $1 million into a company and they sell, I get the first $2 million when they sell. The reason that works is that if I think that this company is going to exit at 2x its previous valuation, and the founder thinks it's going to exit at 10x, then liquidation preference is a way for us to split the difference. So I make more money if I'm right, and the founder at the founder's expense. The founder gets more money than they otherwise would have, and a better valuation than they otherwise would have. So they make more money if they're right. So it is a way to split the difference. And I guess you could imagine a case where Thrive is looking at this and they're like, everything about this deal makes sense, except we have this legal uncertainty. We literally don't know if all of our money is going to vanish into something that turns out to be a nonprofit, and we just can't put all of our LPs' capital into something like that. So you take that risk, and if you mess up, it's all on you. We'll get our money back, and our LPs will be very impressed with us. So yeah, maybe something like that would work. Like, if that was the point of the structure, it is basically like a breakup, like a weird version of a breakup fee. And breakup fees they're this fascinating part of M&A negotiations where you're buying a company and you set aside some amount of money where if you don't do the deal for whatever reason, you pay them that fee. And usually for whatever reason, it is also something the lawyers really negotiate over. But it is things like if there's an antitrust problem or whatever. And they're like those are basically a way for each side to come to an agreement if they just disagree on the odds of some legal uncertainty. But it is a little scary. I would imagine it's a little scary for the other OpenAI shareholders that their capital might actually end up not going to training new models, not going to responding to DeepSeek, not going to launching new consumer apps, but actually going to making LPs of some other investor whole. And then OpenAI would have to come to them and say, not only did we raise money in a deal that gave our counterparty this free put option for the biggest risk, but now we need more money from you. It's the kind of thing that very risk tolerant people might consider, and otherwise not as good an idea.
Maybe in closing, we can just reference this other piece you wrote quickly about how the Trump administration might mean, more kingmaking or more sort of consolidation or champions getting even bigger.
Yeah. Like, so I've always found the idea of national champions really interesting. It's these companies where they're pretty closely tied to the state, and they are a large share of GDP. They will often get favorable, like, laws written in a way that's favorable to them. They often get access to capital either directly through the state or through entities that the state has a lot of control over. And there have been countries that use these to basically get ahead, because what you're doing is you're combining the resources of the state with the incentive structure of the private sector, and that could be totally pathological. Like, there are plenty of cases where the national champion is basically eating some fraction of GDP, kicking a little bit of it back to people with political influence, and otherwise just serving no real purpose. But in other cases, it is just a way for countries to rapidly industrialize without having a complete command economy. And the US seems to kind of under-index on that. Like, we've definitely had cases where there was trade intervention to help favored industries. It may be not a coincidence that Ronald Reagan was a California politician, and the chip industry was very centered in California. And when Japanese chip companies were competing with the US, the Japanese chip companies turned out to face some pretty heavy tariffs. And Bush tried to do some similar things with steel, as have other politicians. And Boeing is also, like, Boeing is a lot closer to a kind of classic national champion, where they're getting favorable, or their customers are getting loans from a U.S. supported financial entity. And it's just really hard to operate a company like that without some kind of legal cover. They get defense contracts, etc. And they're also a viable company. Like, there are just not very many companies that can build planes. And as it turns out, there's a very short list, and they're all state backed. And the challenger is a Chinese company, Comac, and they're also, of course, state backed. So there are some sectors where it's just tough to get much done without that kind of state backing. The US has had less of that, but when you look at something like TikTok, so you have a couple options, one of which is you, Donald Trump, say, I got this totally wrong. TikTok is actually completely fine, even though I wanted to ban it, and this is something I advocated. I'm now the one who wants to save it. That's one possibility. One possibility is you just say, okay, TikTok is really bad. Let's just eradicate it. Let's ban it in the US. It will be gone. And then you've just blown up a pretty substantial business that was worth a lot of money. It had a lot of employees. It was a lot of people's livelihoods. Like, yeah, sure, most of the content is garbage, but Donald Trump was a TV, like network TV actor. He's in no position to say you should not be watching kind of mindless garbage just because it's entertaining and there's a very charismatic frontman. But the other possibility is you say TikTok cannot be controlled by a Chinese entity, but it should continue to exist. It should be controlled by some entity in the US. That entity probably should not be the federal government. Like, I think no matter how rah-rah you are about Donald Trump, having an org chart where he is at the top and someone reports to him who decides what every teen and 20-something, like, what opinions are being put into their heads, seems like a dangerous idea. It also seems like just a nightmare from the government's perspective. It's like it'd be very hard to manage and very hard to run well, and it's just rife with conflicts of interest. But if you have some private sector company that does have the technical skills, does have the business skills, is nominally separate from the US government, but basically is willing to say, here's what we will do with TikTok, here's what we won't do, and you elaborate through all of those constraints, then you can nudge the company towards taking a deal with that entity instead of getting banned. And that works out. It does preserve the value of the company, and then it creates this really complicated situation where now you have this company that has been able to make an acquisition probably at a pretty favorable price only because it got help from the federal government, and it owes the federal government something in return. And whether that means USG as some abstracted entity, or whether it means the current chief executive, is going to be a perhaps deliberately ambiguous question. But it's also, if the problem of TikTok can only be solved with the legal authority of the government and the technical chops and business skill of Oracle or one of Elon's companies, or Perplexity has attempted to lob in a bid, or Mr. Beast, or whomever, if that's the only way to solve it is that confluence of different kinds of capital, then that's how it will get solved.
Yeah. That's a good overview. Well, we're a bit over time, so let's wrap on that. But this has been a great wide-ranging conversation on DeepSeek, its implications, X, the vibe shift, and Stargate, as well as OpenAI and Elon. Byrne, as always, great conversation. Until next time. Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.